So one of my main focuses this year is to build out a very strong banking relationship with American Express on the personal and business side. I'm expecting a sizable deposit to come in from a business transaction. For the sake of the video, we're going to say it's more than $50,000, and I need somewhere to park that capital for X amount of months until I figure out the best way to deploy it. So the question is going to be, with American Express, they have two options for major deposits to get a decent return. It's a high yield savings account that they offer, and they also offer CD options. Both are paying optionally over 4% at this time, which is pretty decent return for low to no risk. So I'm going to discuss my philosophy, my thought process around which one of these I'm going to select for this lump sum of money, and give a little context about my time frame with the funds, so you can also make a similar decision with your money if you're in a similar situation or have deposits you can park that can help you build a relationship with any institution, but especially American Express, as well as get you a decent return on your money without taking much risk at all. So if you've been following the series, you know what a high yield savings account is with American Express. You also know details about the CDs that American Express offers as well. For short context, high yield savings accounts are basically just going to be regular savings accounts with higher interest rates offered on them, usually some special APY. And CDs are going to be certificates of deposit, which are basically also deposit products with a contractual guarantee or lock-in of a certain period of time you're going to keep that money in, and the bank's going to pay you a certain interest rate because you're agreeing to keep that money in for a fixed period of time. So it's very important to understand the functions of these two different products in order to make a decision on what's best for your excess deposits. For me, the first thing I need to sort out is, how long do I plan on keeping this capital? The next thing I need to sort out is, will I need to deploy it prematurely or not? So the interest rates on these products function a little different as far as which one is the most certain, okay? The Federal Reserve is the baseline determining factor of deposit rates in our country, the central bank, as well as lending rates. There's other factors and mechanisms in place, but the Federal Reserve is one of the biggest single factors in where deposit rates and APRs and APYs go. So with high yield savings accounts, I have to decide, do I want liquidity more than I want the return? Because with high yield savings accounts, that money is going to pay me a very similar interest rate to CDs. But high yield savings accounts are liquid. They're regular savings accounts at their foundation. So that basically means that I can go get that money out same day or next day. Because of that liquidity, the interest rates are also fluid. They can change very fast in an instant with barely any notice. And we're currently, at the time of this recording, if you're catching this video relatively fresh, at the time of this recording, the Federal Reserve is in a fluctuating interest rate environment over the last 4 years or so. They've moved interest rates based on the economic circumstances and needs over the last 4 years. It started with COVID, where they dropped interest rates significantly to try to bolster the economy when things shut down due to the pandemic lockdowns. Since then, they've encountered inflation, which has forced them to skyrocket interest rates to the highest they've been over 20 years in the last 2 years in order to combat inflation. So now we're in a situation where the interest rates have been high for the last 2 years. The Federal Reserve is projecting to cut the rates again. If I'm in a high yield savings account, that is going to be basically a forward leaning indicator on interest rates, meaning that interest rate is going to drop premature potentially, or right on the dime of the Federal Reserve dropping the Fed's funds rate. So if I'm in that high yield savings account and I'm looking to get that 4.5%, whatever the return may be at that given time, I have to be aware of the fact that that can change on me at any given point in time if the Federal Reserve is giving indicators or flat out changes the federal funds rate and pulls it down. So the other side of that equation with CDs, I don't have the liquidity. Once I lock in for 3, 6, 12 months, whatever the case may be, I'm stuck inside of that agreement for that duration of time if I don't want to pay penalties. So that basically means I have to be certain that I don't need those funds any sooner than the agreed upon time that I lock that CD up for. The promise to that, the positive is, with the lump sum of money I'm getting, I am going to get that locked in return no matter what interest rates do over that duration of time. The Federal Reserve could drop the Fed's funds rate by 2 or 3%, which would be insane. It's not realistic to happen, but I'm just giving, an exaggerated example. The Federal Reserve could drop that interest rate significantly. It is contractually guaranteed that whatever I'm getting paid has to stay during the duration of that contract. So even if that same CD for a new customer is paying half of what I'm getting paid, I am locked in on it for the duration of time I'm in that CD. So it should make relative sense to you. If you want the freedom of flexibility and liquidity, you're going to have to sacrifice a potential interest rate. If you are more focused on that interest rate and you want to get that fixed return, whatever that dollar amount's going to turn out to be, then you're going to have to guarantee that money to stay locked in for whatever fixed amount of time. And that's the dilemma that I'm in. I have to sit down and assess, how long do I plan on keeping those funds? And how likely is it that I'm going to be able to keep those funds for that fixed amount of time? Or is it possible that I may have to sporadically deploy those funds for an opportunity? And that's the same thing you need to consider. Whenever you have a lump sum of money, are you saving? Are you saving permanently? Do you need the freedom to be able to add or remove those funds at a moment's notice? And are you prepared to take a fluctuating interest rate in order to have that liquidity and freedom? Or do you have a fixed amount of savings or a lump sum of money that you're looking to get a solid return on at a low risk? Because these are FDIC insured deposit products on both ends. But in the case of the CD, you know for sure you can hold that money for a fixed amount of time. What would be the ground floor to separate the high yield savings account from the CD? I would say 3 months. If you are guaranteed solid that you can hold that money for 3 months, 90 days, 3 months, however you want to look at it, then a CD could be your best option because it's a guaranteed rate for that amount of time. And it's probably in this particular environment going to be a really competitive rate to a high yield savings account, meaning you're going to get the same or maybe even more of a rate on that 3 month term. You might have to go up to 6. It depends. You have to check with American Express. So put the link in the description for you guys to check out the website. But because you have to do this based on the timing that you're looking to do this. And interest rates could be different. But you can lock it in for 3 months, then a CD may be a good way to go. If you're not certain that you can lock it in for 3 months, you might need to remove that capital. Then you may want to lean towards a high yield savings account based on my decision. I'm going to film another video once the actual money comes in and I make that decision to talk about the returns I'm getting, because I want to show you the power of a higher interest rate environment and how it rewards savers, which is a rare occurrence in our economy, to be honest. So I want you to comment down below and let me know what your thoughts are around these two products. Do you have excess savings? And which of these two would you do in your given scenario? Or what questions do you have in trying to make that decision with American Express? High yield savings, CD option, which route are you going to go? Or what questions do you have in helping to make that decision? If you want to learn more about myself and the channel to get some context on why I'm able to speak on this with confidence, then you can check out the channel. You can check out the intro video that's linked to the channel. You can also check out the description to learn more about me. And you can check out the American Express series where I've shot several other videos about American Express, the deposit products, and I'm branching out into their credit lending products as well as their business products. So I want you to comment down below, check out the channel, like the video. To all my pioneers, I want y'all to stay focused, stay in motion. I'll see y'all soon.